Scale is the blockchain that's truly built different. Forget gas fees and waiting. Scale offers a seamless Web3 experience with fast, fee-free transactions. Whether it's gaming, AI, or next-gen dApps, Scale is here to power your future. Explore more at scale.space/ecosystem and follow them on X at Scale Network. This episode is sponsored by Ledger. This Black Friday, Ledger is offering an incredible deal to secure your digital assets. From November 29th to December 5th, upgrade to Ledger Flex and get $70 in Bitcoin. Plus, save up to 40% on select Ledger Nano wallets and accessories. These deals are only available while supplies last, so don't wait. Visit Ledger's website at ledger.com today to take advantage of the best offers of the year and protect your assets with the global leader in digital asset security. Meet Kraken Institutional. Whether you're an asset allocator, a trading firm, or high net worth individual, Kraken Institutional unlocks the powerful tools you and your organization need to trade and manage crypto at scale. Reliable, easy to integrate, with white glove service and 24/7 support. Visit kraken.com/institutions and get in touch today. This is not investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payword Interactive Inc. View legal disclosures at kraken.com/legal/disclosures. What's going on, everybody? Welcome back to another episode of the Roundup edition of Forward Guidance. Here we are again, recording again. What's going on, guys? How are you?
Doing well.
Yeah. Quinn's in some European soccer. My name is Quinn. I am in the European Soccer League.
No, dude, this is Messi, bro.
That's Beckham's team. Oh, there you go.
Messi?
Yeah, dude. Yeah, they got to represent. Got the pink. Look at my background. Look at that guy.
Pudgies?
Yeah, baby.
Is that their offense?
Yeah, Miami season.
For the TradFi folks that have no idea what that is, we are looking at an NFT collection. Yes, those are still alive, and then there's a couple projects that did survive, and Quinn is out.
Yeah, everybody who's listening to this is gonna be like, "Oh, here we go again. The macro guys talking about NFTs. It's over."
Yeah, I know. I've been dying this week at my feed where just feels like MicroStrategy is just like taking the hold of the common narrative, and every TradFi person that I follow has been talking about MicroStrategy this week. It just feels like it's really just taking hold of things, and it's driving everybody insane, either good or bad. I don't know.
Yeah, it's one of the most, like, Bitcoin itself is just, I think maybe people have warmed up to Bitcoin a little bit more, but yeah, let's just say crypto as a category, it's one of those things that just gets such visceral reactions in either direction. And it's like, look, it's an asset like everything else. You can love it, you can hate it, or you can just try to make money off it. Like, we're all playing the same game.
You know what my favorite meme is right now is the guy with the Patagonia vest and the lanyard. And
the CFA guy.
The CFA. This is Felix. It's Felix. It's like, ha ha ha. Have fun with your MicroStrategy down 20% today. Ha 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 ha. And it's
because I have, like, my profile picture on Twitter is like a suit, so people just like, so when I tweeted the MicroStrategy's top, someone replied with that. They're like, "Yeah, I would sell it, bro." Like, it's pretty funny.
Quinn, you want to unpack that a little bit, because you got a little shit for that one yesterday, or was it yesterday? But you top take MicroStrategy, did you? What happened there?
Yeah, it was good. I mean, it was just a fever pitch. I mean, we had, like, you could just, I mean, also you could see it in the chart, right? It's going parabolic, and those are gut calls and stuff, but. And then when what gives you more conviction is when you tweet something like that and you get hundreds of replies that are just like coming at you from every angle. And when I do that normally, I wasn't shorting it. It was just more of an observation for fun, because, like, I'm not stupid I'm trying to play the long game. But those are types, like, if you tweet like a long thesis like that and you get that reaction, or sometimes I've gotten it from talking about shorting ETH and things. You double down, like, that's if it's that, it evokes that sort of emotion in people. So no,
the best contra machine ever. It's like, if people are pumping your tires, you better check yourself.
Yeah, get the hell out of there. Yeah, I mean, I was I was tactically, I guess, a little bearish, and one of the things I need to maybe check sometimes is delivering high conviction long form views is probably a better use of my time versus now that I have more followers, when it was only like 20 people that listened to me, you could kind of narrate things in real time and people didn't get their undies in a bundle. But
yeah, and you're stacking that AUM, baby.
Yeah, let's go.
I'm convinced every disagreement on Twitter comes down to just like a difference in time horizon, and just people never understand it. Like it's insane. Like I don't know. Sometimes I'm like, oh, maybe a little bearish short term, and like last week we were talking a lot about taking profits, even though we're still mostly bullish from like a medium to high term like frame structure. But it's just like when you see what's going on, when you see like the president of El Salvador like P&L flexing his Bitcoin gains, like you got to be selling a little bit there. Come on.
I think it's, what we talked about last week, and it got maybe framed incorrectly, was taking profit doesn't mean go to all cash. It means
or short. When sometimes
yeah.
I'll put a like cautious post, and people like, 100% short and show your portfolio, idiot. Like it's like, dude.
Yeah, that's the hard part about talking to the public, is like when you say sell the rips, buy the dips. That's what you're supposed to do in a bull market, because some of the most vicious drawdowns happen in bull markets, and vice versa. Some of the most vicious sell-offs happen. Some of those vicious sell-offs happen in bull markets. In bear markets, some of those vicious rallies happen in bear markets, and that's being able to psychologically know when the tide is turning is really, really hard there.
100%. And there's a lot of different ways you can approach that risk management. Like I've been, we had the options launch this week on the Bitcoin ETFs, which has been really great. I've been looking forward to that for a long time, as somebody who has dabbled previously in messing around with options in more like a, sometimes just for outright leverage on calls or something, but also just for different means of risk management. So I've been avoiding crypto options pretty much this entire time, because either on-chain options just have terrible spreads, or Deribit's okay, but I don't know, just wasn't that interested in it. But now that we have these IBIT options and every other ETF options, it's been really great. So I know we've had some chats this week throughout, just seeing like what are some of the different ways that you can actually still remain bullish but also take some profits and risk manage. So there's a lot of different interesting approaches. So like one option is to, if you had a big holding of the Bitcoin ETFs, spot shares, you can sell a good chunk of that and then potentially replace it with just some sort of far out of the money call or something, just to be able to capture that convexity if it happens, but still secure. And then maybe you lose the premium, and that's fine, but you still realize some actual gains. Or in the same vein, if you have a bunch of shares and if implied volatility gets way higher, you can potentially do like a covered call thing, which I definitely recommend understanding what that actually is a lot deeper before you go potentially doing it. But just to show a couple examples, there's a lot of different risk management approaches, and I'd love to hear from both of you guys, like as actual like fund traders, just some high level thoughts on like getting a little bit more tactical, and what are some different ways that you can still have directional like positive exposure, but also making sure that you take some wins off the table.
Yeah, I mean, not speaking for Tyler, but I think we approach things fairly similarly, and our funds mandates are directionally similar in the sense that they're macro funds, and they're not long moon boy alt token crypto funds that just sit in these assets through plus 90, minus 90. And so my whole thing, and it's something I explain to investors really transparently and spend a lot of time when I chat about markets, is your objectives in the market are different, right? The retail $10,000 punter, okay, sure, yeah, you're going to be like doing high risk, high reward things in meme coins. But when you're running large sums of money and have a lot more focus on capital preservation, I'm trying to make money in all environments, right? So we're sitting here, it's September, October, and we're pounding the table on the upside potential of Bitcoin and some other assets. But we talked about the miners when some of these stocks were half of what they are today. We talked about Bitcoin when it was at 60. We were calling the bottom of Bitcoin on September 6th, and it's up huge from that, like 53. And so you're looking at things through a risk reward spectrum, right? So like, okay, at 53, at 60, I've had the view that we're going to go to 100, and I've had the view that 50 kind of was the bottom. So let's say you're at 60 and you're willing to risk 10 down to 50 to make 50. That's an unbelievable risk reward. And then in a matter of 2 months, this is one of the most prolific market cap nominal gains in one of the shortest time spans we've seen in Bitcoin's history, and just extrapolate to whatever other crypto asset you want, that's meaningful. And if you're not forward looking, right, in September, October, we're pounding the table. Trump's going to win. Get long these assets because it's a really good risk reward. Okay, but if you're still shouting at the mountaintops the same things right now, right? Oh, how could you be more cautious? We're not even to inauguration yet, but and Trump's going to fire Gensler and this and that, and it's like, guys, that's in the rear view, right? Like that happened. Notice the day yesterday, Gensler resigned and Coinbase stock was down 8%. So what's going on? Where that's supposed to be, they're like the company with the most to gain from a new SEC chair, and the stock was down on the day. That's called it's priced in. And so you have to be forward looking. And now we're sitting at 100K on BTC, and you're like, okay, we could easily go back down to 80 or 75. So I got 20 or 25K of downside. And I don't know, I believe that there's some gravity in these markets and things don't get ludicrously stretched for too long. So if you think upside is like to 120 or 115 in the near term or 125, you're that's a 1-to-1 risk reward or less. That's not a 5-to-1 risk, upside. And see, I'm trying to take big fat swings at, really good risk rewards and take my profits and then find the next one. And I'm not trying to be the last guy at the party at 2:30 a.m., waiting for everyone else to leave. And it's time I guess I should go home too. I like to be early and early.
So similarly, one of the things I find that is the most value added is if you can get a little bit of derivatives background, which I didn't have early in my career. It was like you get run over if you don't understand the derivatives positioning. So, for something with, I can't name a specific stock, but for something that's a really high implied volatility, that means your range of outcomes is plus or minus a lot more. So say like if the market the probability is saying this week, this stock will trade plus or minus 30%. Over the month, it's going to trade plus or minus 80%. That is a high implied volatility. In that case, that means that, it's if we talk about the hurricane analogy, if the hurricane is coming towards Florida, your insurance premiums are going to be skyrocketing even before it hits. And so that range of potential outcomes is wide. So you race to buy insurance. In that case, once the hurricane is getting really close and that range of probabilities is really wide and the insurance premiums are really high, you're probably better off selling the insurance, which means you sell puts. Like if you have a high conviction in a stock and the implied volatility is really high, you can lock in buying that stock at a really great price. Granted, you have to have the cash, but you can, if you don't, the yield you can get on a monthly is like, 15, 20%, depending on what strikes you right. So like annualize that's like 150% per year just for selling puts, deep out of the money puts. So like, I'm trying to dance around this, but you should essentially be selling insurance when the premiums are high. So that's just on single stocks, and then vice versa, when there's weird on the macro side, understand that when volatility is low on the VIX, that's your overall macro theme, that liquidity is probably pumping, global collateral is, very salubrious and healthy, and liquidity is good. And so you should be more risk forward. Credit spreads are down. You should be more risk forward on your bets. If those things go higher, the VIX is higher, the range of probabilities is a lot wider, and the unknowns become more unknown. So that's where you kind of like rein it in. You don't have as much edge then. But that's sort of, the general thesis of how.
Well said. I feel like, the gist we're getting at here is that like risk management is not an on and off switch. It's a spectrum. And there's a lot of different things you could do, like just for another example of something that, I have a lot more openness to be able to talk because I'm just managing my PA. But like, for example, I was able to buy some IBIT puts actually, even though I also have some calls, but I bought some far of the money puts because if you look at the volatility smile, the implied vol, it's almost like a positive carry put because as the price increases, Vega is also increasing. And then you also have the delta like downside exposure. So even though I'm owning these puts, I barely lost any money on them because as the price has been going up, implied volatility has been going up.
Yes.
I got a
I
free
love
carry
that.
put. Like,
Yeah, that's
how
great.
about that? Boom.
So this is interesting because a lot of people understand when implied volatility is in like the 100th percentile, you can get some wacky things. You could buy some puts for downside and you lose money because that stock drops 40% along with implied volatility, and that's like the worst feeling in the world. So that's what I mean is that you're much better off selling the insurance.
Anyway. That's what happened at GameStop. You know, people thought they were smart and would buy puts on GameStop, and they lost money even though the stock got cut in half.
Yeah, because the insurance companies, the house makes be a bet along with the house, and so what else is funny is like over the election, everyone's like, you can't have an edge on the election. All these slapdick, risk management guys on Twitter, and it's like you can actually have an edge because the probabilities are favoring you. The VIX was so ridiculously high, and if you looked out a month or two, buying VIX puts at that point was the right play because you're heading into the seasonality. We talked about this for months. Is like the VIX was basically inverted, doesn't stay inverted that long, and you can look out and say that's the best risk reward trade. Even if Harris had won the election or Trump had won the election, saying you have no edge is acting like you're smart, but you're not really that smart because you're not looking at the probabilities of the outcome. Anyway, that's my rant for today.
Oh, no, it's so true. I mean, you protection markets in every asset class, the move, the VIX, oil, gold, every volatility metric was at like year-to-date highs, priced for like World War III and everything. Like if you get World War III, oil goes not up and stocks go down. Like,
yeah, I always say in that case, what's money going to be anyway?
Yeah, and so you had
your nuclear war. Who cares? I'm gonna be in my bunker over here. You guys,
you didn't need a view. Like 90% of my view was that you didn't need a view on the outcome, and if you did, and you got that's just anyways.
My view was everyone had the same view, and
everybody assumed we'd have a repeat of like a contention, and yeah. So I want to talk, maybe we can move a little bit more into the TradFi world here, but we've seen the dollar just broke out to like the highest in I think at least the last year and a half, and same with yields are just continuing to soar higher. I'm curious, like we've been talking about this idea of getting cuts into what is a resilient economy or even like a rebounding economy. Pretty much very little signs of a recession as it stands right now, but I don't know. I just interviewed Michael Cow yesterday, and the interview will be coming out next week. And we were talking about a few interesting things where, you look at what's been priced in. It feels like there's a lot of inflation fear that's priced in right now. You just have to again look at those like long bond yields and the dollar right now, and then you start to think about a few things that are actually going to be likely coming through, in the next year or so. You have this Doge thing from Elon and Vivek in terms of, trying to find some sort of cost-cutting measures, efficiency measures. What does that do to the deficit? There's a question there. And then, you have the energy mandate of increased the oil production as well. He was a pretty big oil bear there, and he knows the oil markets really, really well. So that was interesting to me. You have a labor market that's still cool. You have job openings that are just like completely different from 2 years ago. So I'm curious about your guys' take. Like when I start to go through these different things, and another one is like the deportation thing that might happen next year, in terms of immigration. Like one of the biggest pressures on rent and shelter inflation has just been like the huge amount of rents because these immigrants they're generally not buying houses, they're renting places. And that gets reflected and has been a pretty big squeeze on shelter inflation. So if that reverses, we could see some cooling off on shelter inflation too. So I don't know. I keep going through these different things and it just feels like we've priced a lot of inflation fear. Do you guys agree with that?
I think there's how I see the inflation world is between the structural secular kind of inflation and in which you would probably put housing and just like agricultural goods and things that are just wages in some respects, like they're coming down broadly, but sort of stopping, I'd say, their descent. And then you have the like cyclicals, which you can just kind of summarize as oil and energy commodities. And I think it's two different stories. Like you can also split these into goods versus services, which we know services have been sticky and goods have been very in the gutter. But I kind of agree. I mean, a lot of like the Fed acknowledges what we're seeing now is what they believe to be the right trend. They keep harping on it, but an increasing month over month rate, which you can only write off for so long and just say, oh, it's base effects. It's bad base effects. And they might do that in December again and cut and then take a pause. I think the market's right to be approximately 50-50 because I don't think there's a lot of data we're yet to receive. So I don't think it's too mispriced in either direction today. I don't know which metrics you're looking at, but oil at the bottom of the range, if that breaks out, then I start to kind of, my antennas rise a little bit more. Nat gas looked a little perky this week. And agriculture, I think, kind of just continues to trend up. Like I think it's decent, like appropriately priced. I think what gets confusing is when you combine that with the bond market is the bond market properly pricing these things? And on the one hand, eventually the strong dollar and yields starts to crimp growth. But obviously with the recent dollar correlation, stocks up, risk assets up, dollar up, small caps up. That's a big change, right? And so you view that one more as like, well, I guess, Europe just reported some weak data today. It's capital flowing into U.S. assets. We want U.S. assets. We got to pay up for the dollar. And that's a lot different than, oh shit, like world's going to hell and, sell everything, but we want dollars instead of our currency. So I think the bull case, in my opinion, is the dollar is strong on every metric. You're starting to hit all these, technical TDs and DeMarks and every, the Nevilles and the Jalvins, these technical indicators. And so you are saying it's stretched, but it doesn't need to be, the dollar doesn't need to reverse for really bad reasons, right? It can be like, okay, we're stretched. The U.S. resilience is led the way. And if the Fed does cut again, you might get people to say, okay, like they want to bring the dollar down and the rest of the world's going to start to boom and goes out. And so, I mean, I forgot we called it last week, the small caps trade, but everyone was commenting in the chat like, yeah, hell yeah. And I was like, I didn't even put the trade on. So like, dummy me. but that's, that's been a benefactor.
I was going to say similarly to your point. So this was a headline. Swiss National Bank chairman, nobody loves negative interest rates, including the SNB, but we're ready to implement them again if needed. And then ECB Governing Council Mario Centeno said larger reductions in interest rates can be debated if some of the dangers to the region's economy come to pass. So you have the euro just like rolling out of bed. And this is, I didn't think this was going to happen, but we might be seeing sort of like a 1998 Asian financial crisis in Europe where money left Asia and their currencies got annihilated. And that money came here and it created a boom for the US. And similarly, if Europe is uninvestable and they need negative interest rates to get their economies stewing again, I think that's why you're seeing US growth surprise to the upside and the dollar's strong. But like at some point, the dollar becomes globally disinflationary or deflationary. And, it's what's happening outside the US. We could be having, some inflationary impulses here, but if, oil is falling globally because the demand in Europe is falling off a cliff, that's something we got to take into account too. So I don't know. We could really be in a Goldilocks scenario if Doge works out like they think it should. I don't know if it's going to be as clean cut as to go in there and say, oh, this department's gone, this department's gone, this department, and then you just have like, reduction of all these people. You have to have a way to funnel the amount of those government employees to the private sector. And I just don't think it's going to be as clean as we think. But if it is somewhat clean, you could have yields come lower, US growth go higher, inflation come down, and you have this Goldilocks scenario in the US, and maybe the dollar stays strong in that. And they could even lower rates to kind of be at a more neutral level. And then I don't know, that could be like a whole new 1998 boom, like similarly to that Asian financial crisis analogy. So that's a possibility. Now, I think the world in some senses in this interim period is getting a little geopolitically hairy. And, we see Russia firing missiles. There's going to be some stuff that goes on. It's not going to be as clean as we think. So I don't know. But seasonality wise, we're heading into the worst periods for volatility rallying. The VIX should be coming down here, and I have a chart to show that at some point.
Scale is shaking up the blockchain game. With a gas-free, invisible experience, it's the perfect solution for developers and users alike. Forget unpredictable fees. Scale's innovative model ensures smooth, cost-free transactions, saving users over $9 billion so far. With over 46 million active wallets, Scale is proving itself as the go-to blockchain for gaming, AI, and more. Explore the Scale ecosystem at skale.space/ecosystem and follow their journey on X at Scale Network. This episode is sponsored by Ledger. This Black Friday, Ledger is offering an incredible deal to secure your digital assets. From November 29th to December 5th, upgrade to Ledger Flex and get $70 in Bitcoin. Plus, save up to 40% on select Ledger Nano wallets and accessories. These deals are only available while supplies last, so don't wait. Visit Ledger's website at ledger.com today to take advantage of the best offers of the year and protect your assets with the global leader in digital asset security. Meet your secure, reliable institutional crypto partner, Kraken Institutional. Whether you're an asset allocator, a trading firm, or high net worth individual, Kraken Institutional unlocks the full suite of tools you and your organization need to trade and manage crypto at scale. But it's more than just powerful products. It's about enabling you to build and grow your crypto practice via deep liquidity, industry-leading security, and white glove service. Think 24/7 support from an award-winning account management team and expert guidance through your institutional crypto journey, from onboarding to product demos and more. Experience it for yourself. Visit kraken.com/institutions and get in touch today. This is not investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payward Interactive Inc. View legal disclosures at kraken.com/legal/disclosures.
Okay, so here we're looking at, seasonality of the VIX for the past 5 years. October is down, November is down, December is down on average. But just check out the last two columns. November is usually massively down, and then December minus, the pandemic, you knock that out and it's usually the VIX usually falls too. So you're in this low volume, slow grind lower in volatility, which causes the risk parity funds as the VIX falls, the guys that manage to VAR, volatility adjusted risk, they have to re-lever their books and lever up in equity. So we could see, if there's no geopolitical event, I think kind of a grind up higher here for the next month and a half. That's sort of my baseline scenario. What about you, Quinn?
I'd go back and forth because, the seasonality stuff has been interesting this year. I mean, it's a condition, and it's not a base your views off, but it is real for the volatility and underlying, fundamental reasons, calendar and flows and sentiment, right? Like, it's been a good year. You have, in 2022, if you remember, you had a big, and it might be on here. Yeah, it is. In December 2022, right after that bear slog year, everybody was pounding sales into the year end on tax loss harvesting and trying to readjust their basis and stuff. And then you had this rip in January 23, which shows up here also in risk and Bitcoin and everything as these assets got way oversold. In these environments, there's a different psychological thing, which is taxes, and that's 1231 as well. So what I've also come across is people have a lot of gains, right? Everybody's up, everybody's green. One, you don't want to give the gains back. and you want to keep up with benchmark, and so there's chase, but also there's a hesitancy to recognize sales pre 12/31, depending on type of investor, which is interesting. So I can see it. I'm open. I'm trying to kind of just really watch the tape and the macro indicators that I watch. But I think you have to respect some of these flows and the shortened holiday weeks, and you're seeing it, right? I mean, even this week felt like holiday volumes in many asset classes. And who wants to put a big short on some of these ARK Cathy Wood type stocks, like that are breaking out like insane inverse head and shoulders patterns. Like
just going to mention Rocket Labs, because I watch it every week. It just keeps going up. I don't own it, but I'm watching it.
I mean, I'm looking at all these
viewers better be owning it. That's some alpha.
Like, I mean, the square chart I've seen posted around, I've seen, we talk about these stocks, like, and we've been watching them. I mean, they look like the most dead, left for dead, beaten down things that caught life and are squeezing. And you got probably, all the Reddit, bros rich off their crypto and Doge and everything. And they're bidding these things into their, they're hungover Black Friday and sitting, drunk on Thursday, and they're bidding these things. And who's going to step in front of that? I'm not. Like, who's going to do that? Like some big pod shop that's already gotten blown up on the long short in July and doing it again here. Like, so there's real factors,
especially not at this time of year either. Like, it just, I don't know. The more and more every year I go through these events, it just feels more and more like just the seasonality thing. And like, I just threw this chart in here of like just the seasonality from where we on right now into the end of year. Like, I don't know, man. I don't want to fade that.
Also, people forget I posted a chart on my Twitter, but the active versus passive management is crossing, where passive has more assets. The systematic investors are way more powerful. And get this, this is from Scott Rubner, Goldman. He says, we currently estimate 95% of S&P corporates are in the open window for buybacks. We now estimate that the next blackout window will begin on 12/23. On the authorization front, 2024 year-to-date authorizations stand at 1.105 trillion, up 17% from 2023 year-to-date authorizations. So the buyback bid is huge, especially in a low volume tape, low VIX tape. That's like the baseline of what's happening here. And I think, that wasn't going to change in the election.
I read that this morning and I just kept getting more bullish. Do you have any other key takeaways from that? You just want to head off here while we're on it? Because that thing was mind blowing.
January. I mean, this guy's email is incredible. Go, you have to pay Goldman for it. So just FYI. But their January inflows. January is the largest month of the year for inflows. After 20 plus years for the S&P, I could see investors getting on the sidelines, getting stomped in. So you have a lot of cash. I've been talking about the money markets, 7 trillion in money markets, and then you have this giant inflow of money, generally seasonally in January anyway, from whatever systematic funds it is. So there's lots of bullish stuff here. And what's even more interesting, and this is not from him, but if you go to slide 22. You'd expect market near like all-time highs. You would expect that the bull to bear spread, you'd be raging bulls. And it's not. It fell last week. And then this is even better. Go to slide 17. And I think this is Goldman's chart. This is the prime book. So this is all the hedge funds, net exposure to the Magnificent Seven. They've massively reduced their exposure. And Quinn and I have been talking about this, and Felix, you too, about like the concentration in the Mag 7. And now that's underperforming and it's going to IWM, like we said, over the past couple months. But
yeah, I was holding out on the passive bid into the tech thing, but I gotta admit I've been capitulating on it. And like, you look today, like the Qs are flat and IWM is like up almost like 2% or something.
yeah. And like banks are on fire. There's a lot of different sectors that are really doing well, and that rotation keeps I think the overall bullishness, because people are confused. They're like, oh, what, Facebook and Meta and Netflix aren't up every single day, and Google's it up every day. What the heck's going on? So you don't have the euphoria, which makes me a little bit more bullish, longer term. that this isn't the end of the cycle.
On that point, what's like interesting anecdotally is, typically we had NVIDIA earnings this week. And normally what you see there is like a bid up in vol, because for so long it was the only reason like equities were doing well.
Mhm.
So, there's a lot of volatility hedging going into that. But, this week we didn't really see any of that. And, sort of like, they beat on guidance, they beat on earnings, yada, yada, yada. But you just didn't see it have this like market moving event like it's had over the past year. And I think it's a lot to do with, just this increasing of breadth. What were you going to say, Quinn?
Yeah, I want to touch on that point. We've mentioned it a ton on here, but we said, remember in June and into July or early July, before the big rotation, everybody was pulling their hair out who's a Bitcoin investor is like, what the hell, NVIDIA, and you had everybody slam dunking on Twitter, all the traditional kind of macro takes of like, oh, look at Bitcoin, it can't even rise, and it's a 3x levered NVIDIA, and NVIDIA is going to the whatever. And we're seeing the exact opposite. And these are like Jem Carson, who you just had on, talks about these when you have this volatility supply that pins the index. And if, NVIDIA reports a mediocre quarter or whatever, or the market, maybe it's a good quarter, the market already had high expectations, and it just kind of meanders or falls, and something else in the index kind of goes up. And so you're seeing these rotations. And what I would just note to people is you don't usually see tops when it's these rotational markets, right? It feels healthy in some respects, where it's like, okay, Trump's better for Main Street than he is Wall Street, and might be better for energy than tech, and might be better for Elon Musk's businesses than he is for big pharma. Okay, innovation, right? So you're seeing that these rotations, and usually to their point of like, you don't want to really step in front here. Normally people try to step in front of this, it's getting ahead of itself. Tyler's AI bull bear index, people are and everyone kind of little by little, week by week, gets too bearish too early, has to close, until at the end, everyone's like, all right, throw in the towel. I can't take it anymore because, it's just a force to be reckoned with, this market. And usually end with everything going up together in some respects, versus just, this rotational market is what I would say. So it doesn't feel like we're at that, despite these pockets feeling really juicy, it usually culminates in everything rising together, and we just haven't seen it.
I think this is so good for active management too, because all the sectors that were left for dead and didn't get passive inflows are rallying now. And so if you're an active manager and you can buy banks and whatever, like energy or stuff that didn't do well when the fangs were ripping, and now think about the performance drag of all the big passive ETFs that are going to have outflows here for, could be years, honestly. And that we might be seeing a secular shift. And I think what it is like, what's really fascinating to me is we cross this correlation. Everyone is like, oh, Bitcoin is the same thing as tech. And tech has been sold and Bitcoin has rose. So I think we're moving from a world of centralization to decentralization. And Trump's win was a definite, on the surface, the narrative is Trump bails out his big business buddies, yada, yada, yada. He's not but he is, if you look at some of the policies, like, this is not a political statement, but he's most pro-labor, way more pro-labor. And that's why the Teamsters didn't support the left last time. But there could be, he might be more pro-labor than pro-capital, but people don't really realize it. And those sectors that were, really beneficial to pro-capital, which is like large cap tech, they want low inflation so they can innovate. Those things are kind of shifting here, which is the irony of the whole thing.
Yeah, I think, you look at some of these appointees too, right? And I kind of like to follow the ones that don't get such headlines. Everyone's up in arms about this Treasury nominee, and look at, he picks this Department of Energy guy from the private sector who I can only imagine, comes from, I think it's an E&P company, it's
Liberty,
probably, yeah. And then you see who he picks for the, was an FCC chair or whatever regulates, who's been outspoken about, these tech monopolies. And yeah, if I was, balls long mag 7, because that's what worked for the first half of the year, and I was lazy and kind of kept the longs, like, I don't care what quarter these guys are posting. Yeah, there's some arguments around like Amazon or Google, right? That the sum of the parts is worth more than a whole. So it's not all bad. But yeah, he is more labor versus capital. He's more Main Street versus Wall Street. And that's some of the things we've been harping on. And you don't need, like, it's a dispersion market. So like not everything has to ride together, and it can be healthy.
Totally agree.
Yeah.
You guys care if I bring up something that's kind of interesting, which is this global collateral, this change in global collateral? Slide 19, I've heard during this bull market, a lot of baby boomers have been like, I talk about Bitcoin and they're like, oh, is Bitcoin so stupid? This is just Bitcoin. And this is what I saw this was from Bank of America. US Treasuries on course for their third loss in 4 years. So you have 2021 Treasuries are down 4%, 2022 down 17%, 2023 up 4%, 2024 down 1%. And I don't know exactly which Treasuries or what they did, but it looks like it was inflation adjusted too. But relatively to these returns, how can you sit in Treasury bonds? And I'll say this till the cows come home. What millennial or Gen Z is investing in a Treasury bond right now? So there's a psychological shift of what a reserve asset is here. And I'm happy that boomers still want to own Treasury bonds because it keeps our rate of financing low. But like with a 7% deficit, and they better hope Trump goes in there and takes all the government crap out so they actually get a return. But if they don't, you're sitting in an asset that is just eating away. And to me, the petrodollar reinvesting of US assets into treasuries, why don't you put your incremental dollars into Bitcoin? I think that's actually what's happening here and why it's disconnected. I think that's the overarching biggest thing in the market right now. But what do you guys think?
I love this point because you see I've seen criticisms of like, why do we need a strategic Bitcoin reserve? Central banks already have billions and billions of dollars in foreign exchange reserves, right? Well, yeah, because they're being stuffed with yields that are just getting hammered. Like, why would you, if you're a foreign exchange reserve manager, like, are you doing your fiduciary duty if you're just getting clipped like 10% on duration like that? Like, that's just like, that's not the world we live in anymore. We've been living in this world of 40 years of declining interest rates. So it was a positive carry for foreign exchange reserve managers, right? Like they're gaining on the duration, but that's not the world we live in anymore. So, you have to start to think about, okay, well, if I don't want to be owning that duration, what do I want to own? It makes sense to own some gold, of course. It makes sense to own some other commodities, but there's no other currency that is, hiding from this issue. So then you start to think about some alternatives and you're like, okay, well, maybe having 1% of Bitcoin isn't such a bad idea in the face of such duration pain, because rates probably won't go much lower than they are right now.
Yeah.
It's something, right? Jesus, like, look at this. It's fucking supposed to be the safe haven, and you're just getting smoked. And you have to also measure these things. This number, I believe, Tyler, is nominal. So you slap on the 2021, 2022, 2023, 2024, 4 to 10% inflation. And 2022, you're down 30%. You're down 30% in real terms.
Yeah. I don't know what they're probably averaging the duration. I don't know what it is, but either way, they're down.
Pick your inflation metric, right? Pick your M2 or pick your CPI somewhere in the middle. And this is horrific, right? So like, it's not just your portfolio's down this number, it's your purchasing power. And I think it's something I actually am writing in this current note I'm putting to investors, like, just keep pounding home. Look at the world in real terms now. And people, a lot of people I speak with who like their fixed income allocations are married to this yield component and this coupon and this cash flow income component. And can't harp enough as like, that's worth way less today than it used to be, and evaluate everything in this real. Like, congrats, you get a 4% payment every year, but that's just kind of keeping up with inflation. Your real is basically zero. Whereas gold, you look at the gold divided GLD divided by TLT, you can just see in the chart what global countries are using as their reserve asset, and it ain't treasuries. So you got to rethink your portfolio in a first principles approach.
The one opposite point to this I want to bring up. I don't know if you guys caught my interview with Stephen Moran where he was hashing out different like tariff ideas, potential impacts, and something that he brought up, which was basically force stuffing of other countries with duration bonds in exchange for protection from the international American security apparatus. So effectively what he was pointing out is that, okay, well, maybe what we could do moving forward is offer century bonds, like 100-year duration bonds, to these countries that they hold. And likely, if we're agreeing that we're in this secularly higher inflation, that's a pretty big duration hit you might be hitting. So what if we also offer like a BTFP type facility where the central bank protects those bonds at par? So even though you're taking, I don't know, a 20% haircut on the century bond, we will happily backstop that 20% duration hit with like a backstop facility. What am I getting at? That sounds a lot like yield curve control, doesn't it? Because it is.
Yeah. Well, it's only payback for us buying the Austrian 100-year bond in what was that, 2020, when it was like, now it's at 50 cents on the dollar.
That was genius. Like, why didn't America do that?
This is what I was asking. I was at Franklin Templeton at the time, and you could issue bonds for a negative yield. They paid you. And I'm like, why don't we do that? And they had some compliance, issue where they couldn't do it. And Warren Buffett did it 2 weeks later.
Yeah.
But
yeah,
it was so funny. And then, our asset, this is what's so bad about asset management is our asset managers. If you go look up that bond, I probably could do it right now, but I think it's like T. Rowe, and actually T. Rowe, it's like Vanguard and BlackRock are the top holders of that bond still. Like no U.S. retiree knows that they own that thing, and it's took a 50% haircut
because they're going to own it for
50% haircut from Austria on the duration. Jeez.
Yeah, you want Austria? That country won't exist in 100 years.
No.
It's because they're
about asset management. They gotta deconstruct that problem.
It's because they're gonna hold the thing for fucking 100 years. But yeah, that's why didn't we hear about a big macro manager shorting that thing? Like, that's the freest money. I mean, by Buffett just tapping the capital markets, he basically did. Or if you took out a mortgage in 2020, but some of these trades, when you look back at the just absurd level of I mean, there's just so much. One of the things, actually, I should have put this in the question list for Stephen Moran, Felix. One of the things I actually look back at the Trump presidency, and it's very probably minor overall, but Mnuchin was floating the idea of a 100-year U.S. bond, or at least a 50. And this was when 2020 rates were absolutely at the ground. And I was like, and in hindsight, obviously 2020, but that would have been a killer trade, right? You're printing these 100-year, 50-year bonds at 0%. I mean, you think of the heyday Yellen would have had if she had that much flexibility now, if they
that's the thing, actually Danny Dan, like friend of the show, has been on a couple of times. He brought that up, that like, I think one of the biggest misses Yellen had was not trying to term out that debt. Like they chose to run up the TGA and issue $1.5 trillion in T-bills at the time when rates were the lowest they've ever been in the last 100 years.
I got a great
They could have issued duration,
Look at slide 21. There's a great chart on this. This is from Larry McDonald's Bear Traps report, who actually has got great stuff. Look at this, the short-term issuance of treasuries. Look at how it's changing over time. The blue is short-term, 2 years and under. Medium term is the red. Long term is 20-year. So you're spot on. Like, we just missed the boat when we could have. When globalization was at its peak, we should have been issuing so much debt. But I don't know. Maybe the argument is you would have had.
Well, the argument is it came at a time where they were trying to accomplish the exact opposite. They were absolutely flooding the system with liquidity, and that would have been a massive detraction. And so it would have gone against their. it would have gone against their
They could have
core.
bought part of the bond to create the demand, though. You know?
Yeah, but we track down like what these chickens are starting to roost now, because we've been talking about everybody looks at T-back every quarter now and the QRA, and this is why, is because we're getting to this point now where percentage of of total issuance like for bills is just skyrocketing. And whoever is going to be the Treasury Secretary next year has a lot to deal with. There's a lot of bills. They haven't changed the maturity duration, like composition, and so they've got a nightmare on their hands. I hope that Trump chooses somebody who's going to be effective in solving that. But when you think about the original cause, it's what we're talking about here, is that they just issued $2 trillion in bills and just flooded the system with liquidity.
But wouldn't you, if you game theory behind that, wouldn't you just lower rates on the front end if you have control of them? And then
that's what I said in the Ford guidance telegram. I was just like, yesterday, I was just like, well, what if Trump just forced rates to zero, issued a shit ton of like of debt again, and then I mean,
it's not the craziest thing. In World War II, they did yield curve control. It's like now you have more debt now than then. They're going to have to do all that stuff. And I think the smart people know that Bitcoin is the release valve for all this. And that's at the end of the day, like that all roads lead there. And what's so fascinating to me is that I've heard more, older people calling this a bubble, which makes me think it's not a bubble. And then I also get a lot of calls being like, oh crap, you know what? I missed it. Should I buy in here? And so they haven't bought in yet. so once it crosses 100K, we'll see if we get that gamma squeeze, baby.
I think what you mean to say, Tyler, is it is a bubble, and it is a centrally planned and coordinated and manufactured one. And this is the
sovereign bond market bubble.
Yes. What's the bigger bubble? I'm always like, would you rather hold a treasury? Is that the bubble? If that's the bubble, then Bitcoin's also a bubble. But you're controlling that bubble. So this bubble, it's like you stop this, but
that's why I posted that CFA meme, and I don't know if everybody got it, but I was just like, I don't know, Bitcoin looks like a Ponzi scheme. I'd rather own long duration government bonds. And I wasn't saying they're trying to be safer. I'm saying they're choosing the Ponzi scheme that they're comfortable with.
Yeah. I mean, if they let the market be free, who knows what would happen, but
David, is it David Dredge or God, what's his? I think that's who it is. Not. It's not Drudge. It's like, I think David Dredge is his name. But the guy, he sits in Singapore and he writes a monthly piece, and he's all about long vol. And he's like, you have to just fundamentally look at the world differently, right? Because either you're comfortable taking inflation on the chin and just seeing your fixed income returns and your 5% S&P returns and you're just stomaching this. It's basically like private equity. You're seeing on paper something that looks normal, but your real returns suck. Or you're saying, no, I'm okay. I know what game is being played. It's a very inflationary game, debasing the currency game, and I need to play high vol. And yes, that's going to be more painful and volatility on the surface. And so I'm going to see these swings that look more painful or are crazier, but in a real term, that's the release. That's what you have to be playing in.
That's a big macro theme for me, which is, if you think about this, the way, how it started, I think about this all day, but Warren Buffett created the risk adjusted return. He sold insurance, and what you're doing is you're just shorting volatility over a generation. And when you short volatility over a generation, you annihilate the middle class. And now the middle class is saying, we don't want that. And that's why things with long vol are working. That's why certain guys with stock that they can sell convertible bonds to with really high vol are very good investments now. And maybe that's the opposite cycle, a 40-year cycle unwinding from short vol to long vol. It's an interesting
volatility is vitality, as that person says that you allude to.
Yeah. And you're at this point, in secular stagnation, it's risk parity. All these strategies that perverted investment because boomers were getting older and they wanted risk adjusted returns, it stultifies growth of real investment. You also do financial engineering, and it just, what does that financial engineering really do? You're just kind of stealing money from a different pocket or a different echelon of the social structure. you're not really creating anything new. It's like the Boeing, Russell Clark talks about Boeing, where like instead of actually innovating and investing in the future, they just showed to do financial engineering. And then all of a sudden you have this moment where, bam, your stock just sucks because you chose to do all these other things instead of actually innovate. And so that's sort of where we're at. And now you're forced to innovate. You're forced to go long volatility. Otherwise, you're going to be smoked. And everyone thinking that investing in a treasury bond or risk-adjusted returns, you're just going to slowly, it's going to be death by 1,000 cuts when all these crypto bros start making it a shit ton of money. And they're going to be like, oh, have fun getting, getting
rich. And even like the AI people, just like, risk is coming back, like, I don't know. One little signal for me is just how much appetite does humanity have to explore space? And, we've talked about that before. You brought that up a couple times, Tyler. But like, we lost this will to dream somewhat, and to take on a risk and try something. It's like, no, we'd rather just sit in the middle of the normal distribution instead and clip those Sharpe ratios.
Yeah.
Go ahead.
I did an interview on political philosophy this week, which we may or may not air, but
we're airing it.
So I think I dig this stuff because we talk about like what it means to be human. And the past like 40 years of modernity, we've just stopped thinking about like doing cool things as human race. It's like we just kill ourselves with entertaining ourselves with video games and porn and all these like dumb things instead of trying to solve problems for humanity. And I think that's really where we're going here is we're going to space, and the space stocks are telling you that's what's happening. And so we'll see if it keeps going. There could always be a war or something that derails it, but that's, I think, generally the macro backdrop.
Yeah, I think an interesting analogy, something maybe it won't be explained well because it's the first time I'm talking about it, but commodities are cyclical. The business cycle is cyclical, and everything in nature, so life is cyclical. And historically, markets, people are used to these big boom and bust oil and gas commodity cycles, right? Where the economy runs super hot, everything's booming, and you need more and more because that's what the world runs on is energy, oil, and you'd get these big bubbles, big bursts because supply demand. It's just like a housing. You build too many houses, something tips. You drill too much oil, something tips, and I would say think about the world moving to like that, but liquidity. We've moved away from requiring natural resources as much because of efficiency, productivity, technological gains in the electricity energy world. And now that's kind of shifted to the boom and bust cycles are liquidity boom and bust. And what's the commodity to protect yourself against liquidity boom and busts? That's either being in Bitcoin or out of Bitcoin. And it's the purest form of protection against monetary debasement. And yes, it's just like old commodity cycles where you're flying high and you're getting crushed. But
dude, I love
in
this.
a world where we don't have any more goods, natural resources, inflation because of technological productivity gains, you have the debt cycle, the liquidity cycles, and that's kind of taken over the business cycle, and it's what's rang as the most important. And I tell people, I used to do a lot of oil and gas stuff. Bitcoin, it's just like another commodity, but it's just a different use case than what oil is or what natural gas is. But it's still cyclical. That's just how markets work. But if you start to think in these like non-traditional angles, it all like the shrub on
take off your Patagonia vest and your lanyards. Thinking philosophically. The age of the technocrat is over, baby. No
Take
offense.
some risk.
Yeah.
He says when you realize it's all nonsense, then it makes sense. That's exactly
Yeah.
But to caveat that, we can change our opinion if there's war or some supply chain issue. We'll try to keep our eye out for it. We're not dogmatic in these views.
No, you're right. Look, guys, that was a lot of fun. Really liked this week's episode. That was great.
I'm gonna get cozy and with some popcorn and listen to Tyler's political philosophy one. That's gonna be a banger.
It's gonna bang.
I'm telling you, this guy, he's pretty good. He's pretty good. It might be a little bit out there, and I think people, but I want to
I'm
hear your
so I'm super fired up. Yeah,
Did you do it in Joe
fun to get both.
Rogan's studio with a couple doobies and glass of whiskey?
No, we did it with these lovely children's paintings in the background. So it's not
Perfect. All
Not
right,
as
guys.
fun.
Have a good weekend.
Cool.
Catch y'all later.
See you, boys.
Peace out.
well,
Looking for a blockchain that combines high performance with zero headaches? Scale is your answer. With its advanced parallel processing and modular sharding, Scale delivers gas-free transactions and limitless scalability, perfect for gaming, AI, and consumer-facing dApps. Already a top 10 blockchain on dApp radar, Scale is powering next-gen use cases with over 750 million transactions and counting. Discover the future of Web3 at skale.space/ecosystem and stay up to date with their journey on X at Scale Network.